Welcome to The Explainer. Today, we're totally decoding a massive, hidden financial engine that practically runs the entire world. It's working silently in the background right now, actively shaping the global economy. And yet, honestly, so few people actually understand how it operates. Think about this for a second. What invisible market out there directly impacts your job, the interest rate on your mortgage, your personal investments, and yeah, even the wild price swings of crypto? Take a guess. And before you shout out the obvious, no, we're not talking about the stock market here. And we aren't talking about Bitcoin either. We're talking about the bond market. This is a foundational piece of the entire global financial system, and it's worth well over $1 trillion. In fact, it's arguably the single most important piece of the economic puzzle. If you don't understand it, you kind of don't really understand money. Okay, let's quickly dive into our roadmap for today. First, we'll uncover the secret market, figure out what exactly a bond is, take a look at the government debt machine, decode prices and yields, and finally, explore the ripple effect this has on stocks. So starting off with the secret market and what exactly a bond is. Let's strip away all the intimidating financial jargon. At its core, it's pretty simple. Imagine you have a great idea for a small business. You borrow some money to get it off the ground, and in exchange, you promise to pay that money back later with a little extra on top. That's a bond. It's just a formalized loan. In the financial world, we call the borrower the issuer, which is usually a massive corporation or a government. And the lender, well, that's the investor. They provide the capital. Moving right along to part 3, the government debt machine. Let's scale this concept up from a small business to the ultimate borrower, national governments. Governments spend a lot of money to stimulate the economy, right? But their primary revenue to actually pay for all that comes overwhelmingly from taxes, as you can clearly see here, with 89% of the UK's revenue coming from tax collection. But, governments routinely spend way beyond what they bring in, which creates these massive annual budget deficits. Stack those deficits up year after year, and as of 2025, the total UK national debt sits at a staggering £2.7 trillion. And if you cross the Atlantic, the US national debt is a whopping $36.7 trillion. Literally, just try to wrap your head around that number for a second. It really begs the question, where does all this extra money actually come from if it isn't coming from our taxes? Well, to get that extra cash, the government borrows from the public by issuing bonds. The treasury literally holds auctions to sell these bonds to investors all over the world. We're talking banks, pension funds, and even regular people. All right, part 4, decoding prices and yields. To fund this massive debt, we need to understand how these auctions actually work. So let's do a quick rapid-fire vocabulary check to build our foundation. First up, principal. This is super straightforward. It's just the initial amount of money being invested or borrowed. Next is the coupon. This is the annual interest payment you receive. And the absolutely crucial thing to remember here is that the coupon is fixed. It's a set percentage that stays exactly the same for the entire life of the bond. Then we have maturity. This just dictates the schedule of the loan. It's the time frame until the loan is finally due and the investor gets their principal money back. And finally, yield. Now, what's really interesting here is the difference between yield and coupon. Remember, the coupon is a fixed percentage, but a bond's yield, that is the actual real-world return the investor gets. Why? Because these bonds are constantly being traded on the secondary market, which means the price of the bond itself is always fluctuating. To make this completely intuitive, think of it exactly like a giant seesaw. This is the golden rule of the bond market. When the bond price falls, the yield rises. And when the bond price rises, the yield falls. They are perfectly inverse. Global investors are constantly buying and selling these bonds based on where they think inflation and the broader economy are headed. Now, here is where things get kind of concerning for those giant government debt numbers we looked at earlier. Right now, a ton of government debt is tied up in short-term treasury bills. These mature incredibly fast. We're talking 6 months, 12 months, 18 months. To pay off the old borrowing, the government constantly has to issue new short-term debt at these intervals. This never-ending cycle is what we call rolling over the debt. And since market rates dictate how much it costs the government to borrow, when yields rise, the government's bill goes up. To put that into perspective, the U.S. is currently paying roughly $3 billion per day just in interest. $3 billion every single day. That means a massive, growing chunk of the country's GDP is being eaten away just to pay off interest, leaving less and less money for essential things like infrastructure, defense, and healthcare. Which brings us to our final section, the ripple effect on stocks. So, how does this invisible bond market actually manipulate the stock market? Well, U.S. government bonds are considered pretty much the safest investments in the world. You get a guaranteed payback, which we call the risk-free rate. Stocks, on the other hand, they're risky pieces of company ownership. If a company tanks, your stock tanks. The extra return investors demand for taking on that stock risk is called the equity risk premium. So the key takeaway is this: when bond yields rise, that premium shrinks. Safe bonds start looking incredibly attractive, and investors start dumping their risky stocks to buy bonds instead. And this risk dynamic exists entirely within the bond market itself, too. You have super safe government bonds with low default risk compared against corporate bonds, which carry a much higher risk of bankruptcy. The gap between those safe government yields and the riskier corporate yields is called the high yield spread. When there's fear in the market, investors demand much higher rates to lend to corporations. So when you see that spread suddenly widen, pay attention. It is a flashing warning sign of trouble in the financial markets. Which leaves us with this incredibly powerful thought from our sources to wrap things up. The bond market isn't just a mirror reflecting the economy, it actively shapes it. When interest rates in this massive, invisible market shift, it can literally slow down or speed up the entire global engine. So the next time you hear about bond deals, remember, they're actively shaping your financial future. What other hidden mechanisms are driving our economy that we don't even see? Keep exploring, and thank you so much for joining me for this explainer.